Hello, everyone. My name is Robin Dolezal. Today is Wednesday, February 16th. With me, as always, is Dan Mental and Alex Pars. Together, we are with Ironwood Financial. How are you this morning, gentlemen?
Good, good. Yourself?
Very well, thank you.
Daniel, talk to me. Where'd you watch the Super Bowl?
I sat at home
Yeah,
and watched it with my boys and my wife, and obviously Ellie's off at school, so
that's really upsetting because you are the most social of the three of us. And I feel like I was even more social than you this time.
you know what? Getting older, Robin.
Yeah. I'll tell you, Dan, you know how much I am into sports. Probably found out the two teams a day of. But I will say, usually I watch, for the commercials and it's on in the background. I watched that game the whole way through. That was actually a really good game.
It's being considered one of the more boring games. So
Well, maybe I'm just really into football. I didn't realize it. I thought it was a great game anyway.
you should
What
have
about
watched
the Olympics?
the.
Alex, are you watching any of the Olympics or no? I know
Yeah.
you're.
It seems relatively dull, though. I mean, we watched some Skellington or something, and it was like, okay, these guys are going really fast, and nobody's catching up to the first guy who went. So
Yeah.
really very interesting. There's no
Yeah.
changes or anything. It was just, no, he didn't do it. No, he didn't do it. No, he didn't do it.
You know,
I like,
what's
I
funny
like
about
the,
that?
I like the flying squirrel one.
Oh,
You know
the
what I'm
ski
talking about?
jump.
The skiers? Yeah. They're giant. They look like flying squirrels.
Yeah.
Yeah. Anyway,
Hey,
okay.
For some reason, Jules and I have been watching curling, which
That's always
if
a
you're
good.
from the Midwest, that's kind of something you would get to do, like playing darts at a pub. You go curling, so it's kind of funny. And you'll notice most of them are from the Midwest. But last night I found myself looking up rules to figure out the scoring of curling.
Yeah, we
Well,
did.
if
We
you
did
guys
watch
know,
curling.
Melissa's, half her family's from Canada, and her dad, was a curler, not, professionally or anything. But so we've been watching curling as well. It is actually pretty enjoyable. All right, guys, well, let's get started. Dano, I mean, the market's still volatile so far throughout the year. Looks like I'm looking at the Dow as of today. We're down 178 points. Give us your take. What's going on?
I think what you're seeing over the last 2 days is probably a good indication of what we can expect probably until the midterm elections. Yesterday, obviously, the market had a really good day because there was a de-escalation between Russia and the Ukraine. But reality is, Alex kind of told me something funny, but there's no reason for Russia to really leave because, I mean, driving oil prices up. Today, oil's having a great day. Ironically enough, crypto's getting crushed today. So that sell-off is continuing. And I think a lot of that is with the lack of disposable cash for some of the younger generations. We're seeing as you mentioned, oil, but we're other things doing well. Gold is doing pretty well today, which is unique, but considering that the dollar is getting strong. Long and short is, I don't think Wall Street cares one bit about what's going on over there. I think what Wall Street cares about is inflation numbers came out pretty high, kind of record high. Alex, I'm assuming you'll talk about that a little bit. And let's face it, at its core, if there's high inflation, who gets hurt the most? Those people on fixed income, i.e. Social Security. So they tried to stave that off, right, in January by giving one of the highest increases to Social Security ever. Of course, they did kind of a give and take scenario where they changed the Medicare expenses. So a lot of people got hurt more than they got helped on that 6% increase. But if the Fed is looking at what's going on with unemployment and they're looking at what's going on with inflation, Wall Street's worried that there's going to be a lot of rate hikes this year. In fact, I saw an article that said they might raise it probably every quarter, but at a rate of almost 1.75%, which would be pretty historic if they raise interest rate that much. Alex and I were debating that this morning, whether or not they would really do it that much and whether or not that's priced in. But remember, the acronym TINA, there is no alternative, is very real. And if interest rates on safe investments go up, you will see people leave the stock market. And again, why does the market go up one day and down the next? Well, if it goes up, there's more buyers than sellers. Pretty simple game. It's an auction. If it goes down, there's more sellers than buyers. And if there's an alternative that's attractive for people that would have a desire for safe investments, this is the way it could happen. And by slowing down the economy, that's not good for earnings. So the market, in my opinion, and actually all of our opinion, because I know we sit in our investment policy meetings every week, what we're seeing right now is what we're going to continue to see. Volatility. People can't find a lot of interest on bonds. I know, Alex, you're going to talk about that, which is causing some frustration for people. Dividend paying stocks have actually held very well this year. And so we're trying to continue that as part of our ongoing buy strategy. Tech's something you'll never want to give up on, but as interest rates go up, tech's going to continue to get hurt. There's probably a buying opportunity at some point. But we're in the world of volatility right now because they're trying to figure out how to, with a combination of keep people spending money, keeping interest rates low, but also stopping inflation. And unfortunately, those two don't live in the same world.
So Alex, if it's not 1.75, you got, where's your crystal ball? What do you think the Fed's going to do this year?
I would be very surprised to see them raise the overnight rate by that much. I mean, they haven't done anything yet, and it's already March coming up here before they do any moves. I would expect them to do a quarter point raise in March. Of course, what I'm hoping for is to see the February numbers for inflation come down off of their highs.
Mhm.
And that would be, it's tough to predict. It's kind of like, remember when we were watching Powell after the last Fed meeting, and every person asked the same question, well, what are you going to do next? And he said, well, I don't know. That's in the future. Depends on what we feel like at the time. Well, that's definitely in play. The question is, where do these rates go? So if these rates, specifically the inflation rates, I believe they're high because of the free money and the supply chain shortages. And I think the free money is starting to dwindle. And I assume the supply chain shortages should start to go away. So anecdotally, we've talked about this. The McDonald's by my house last summer was hiring for $16 an hour. Now they're hiring for $14 an hour. So you're starting to see some softening. We actually just hired a part-time person to help Emily out. And we had, 100 applicants maybe. So the labor market isn't as tight as, you hear anecdotally. It may be people just don't want to work in that type of job.
Mhm.
So inflation, I'm hoping when we get the numbers for February are lower than they have been in January. And I think there's a lot of reasons that could very well be the case. Like Dan was talking about, those people who are living high on the hog on their crypto profits, on their meme stock profits, they're not living so high on the hog right now. And so they're not spending money as much as they were. I mean, when was the last time you heard about some ridiculous NFT purchase? We're hearing about a lot of those a couple months back, far fewer now because the money's just not there and people aren't willing to give it up at this point. So to see 6 or 8 rate hikes this year seems awfully aggressive from Fed perspective. I mean, the supply chain shortage, the labor shortages, they continue to persist, and they're messing up the economy. And so if you said, hey, on top of that, we're going to raise rates like crazy, I'd be surprised to see the Fed taking as aggressive an action as that.
Yeah.
I mean, I would expect to see March, we get a quarter point, next meeting, maybe a half a point, and, then wait and see what happens. That's what they did last time, if you recall. They said, let's see, what these rate hikes do, as opposed to just throwing one after another. They'd poke the market and then see what happened. Then they'd poke it and see what happened, as opposed to just willy-nilly going after it.
Yeah. So Dan talked a little bit about this, and we'll come back because I know Dan wants to talk about this as well. But all I see this news on the news this week, though, is Russia, and Dan already alluded to this. Talk to us. Is this an issue at all for the stock market, or is this just something else?
Dan?
Oh, Alex, I was kind of hoping you'd tell the anecdote that you shared with me earlier.
Oh yeah, it was funny. I was talking to my mother, and she said, Putin would be crazy to invade Ukraine, but he'd also be crazy to back down, because ever since they've been having this little headbutting contest, the price of oil has gone through the roof. I mean, we're essentially at $100 barrels of oil. I saw an article this morning said, don't be surprised to see $7 a gallon gas soon. And for them to back down or invade, there may not be a good reason for them to do it. I mean, as long as they keep talking, think North Korea. How long has he been threatening? For years and years and years. They keep threatening, keep oil prices high. That's great for Russia.
I was thinking about that and, but you know, how it's moving the market and thinking about inflation and everything else. And we're always talking about the amount of free money. You know, we've talked about it. We've given examples. If you decided not to work in young kids, I saw an article today that surprised me, which was fascinating, which actually made me feel good because that meant that a lot of that money just didn't get blown. But the amount of people that work for small businesses that started their own company went up 3% last year. And they said it's mostly almost directly correlated to stimulus checks and the child tax credit. So hopefully some of these people will continue to stimulate the economy, which was that design. And I would agree. I think that we'll probably see a lower inflation. You're seeing a lot of things that the supply chain is loosening, and you're going to not see people have as much money. So the prices, maybe they don't come down, but we don't see these increases, which will hopefully mean the Fed doesn't do that whole 1.75%, which would be kind of scary for the market. Now, if it is priced in, like the article I was reading today, and they don't give us 1.75, well, then that actually mean the market should react pretty favorably.
Yeah.
I can't see the market having really priced in that much of a rate hike.
Doesn't seem like it's been that volatile, but
Yeah.
All right. So the last topic we want to talk about today was the bonds. You know, what do people do about bonds, especially now with inflation and low interest rates?
Yeah, a lot of people are asking, you know, one of the problems with bonds is you have what I would call statement shock. Okay, you look at them and you want to know, why are they always losing money? And I know you guys love my art, so I put together a little
Well, I can't wait.
put together a little chart here. Can you see that?
Yep.
Oh yeah, fancy.
Okay. All right. So the way bonds work is they're typically issued for very, very long periods of time, and they're issued at what the prevailing interest rate is at the time. So I'm using the example of a bond that was issued in 1995, back before the Fed had all these fun games going on, and it might have been issued at 6%. Okay. So what that means is that bond was issued at $100, and it's going to pay $6 per year in interest. Okay. So if we buy this bond in 2022, when interest rates are 2 or whatever they are, it's not fair for us to get $6 per year, right? Because otherwise, you know, everyone would be buying this bond. Well, that's what actually happens. Everybody does go out and buy this bond, and as they do, it drives the price of the bond up until you get to the point where that bond is really just paying the same 2 as everything else. So in this example here, we're buying it $105, and it's got 3 years left, and it's going to pay $6 per year. So it's going to pay out $18 in interest, and we're going to lose, you know, $5 in principal rather. There is no ifs, ands, or buts there. We are not going to keep that price premium through the end of this bond. It will lose principal. There's no question. Okay. So we're going to lose that $5 no matter what, but we hopefully will get our $6 per year or $18 in interest for a net gain of $13 in this example. Okay. Unfortunately, you can't get a bond that good these days, at least one that's at least decently rated, because that would be, you know, about a 4.25% interest rate. Well, so what's that mean? That means reality is, if we bought a bond like this today, we'd probably be paying closer to $110, $111. So you're going to see $100 of principal get eroded down to $90. But elsewhere on your statement, you're going to see $18 in interest. And this is a question we get all the time. Why are we buying these bonds? They just lose. They just lose. No, they're not losing. They're just losing principal and paying out more interest than you're losing in principal. So very common question, very frustrating, but that's the world we live in. I mean, we don't want to buy a bond that's 30 years long right now, because if we did, we'd be locking in today's interest rates for the rest of that life of that bond. And I honestly don't think that's a good idea, regardless of whether we see 2 rate hikes or 6.
I love your picture. I think that's great. I thought you were going to do a hand-drawn one, though.
Yeah, I know. It's I've gotten a little better in the last couple of years at using Microsoft Paint or whatever it is.
Well, thank you for explaining that, because we do get a lot of those questions. So anyway, I know you guys got meetings coming up. I do appreciate your time. It's always fun to get on these with you guys. If you have any questions that we did not address today, folks, please don't hesitate to reach out to us. You can find us at ironwoodfinancial.com. You can also reach us at 888-271-4646. If you're watching this and you're not a client, please don't hesitate to reach out as well. We do talk to folks all the time, bounce ideas off each other. And anyway, it's a lot of fun. So anyway, guys, have a great day. I will see you guys soon. Until next time, folks, have a great week.
Take care.